Good morning, traders. My name is Timothy Hellberg. I've been a professional trader for over 12 years now. I've had a professional career working for trade desks around Northern Europe, but I've also run my own companies inside of algo producing and also developing other traders, coaching them, as well as providing educational material from now and then. I've had a history of running managed accounts, signal services, etc. But today, I'm bringing you a market report in collaboration with IMGFX, the People's Broker, and I'm doing this for week number 26 of 2022. And sadly enough, this will be the last market report that I do in collaboration with IMG for now. But if you want to connect with me on socials, feel free to do that. Preferably LinkedIn is the easiest way to find me, and there you will find all of my credentials, where I have worked, for example, my FITMO certificate that I passed their challenge, etc, etc. Basically that I know my stuff, but if you've been watching these market reports by now, you do already know that I know my stuff. So, before we jump right into it, let me just remind you that this is not a recommendation to buy or sell anything. This is simply my take on the markets. You should always do your own research, have your own trading ability, and never trade with money that you can afford to lose. So if you want to pause it and read the disclaimer, feel free to do so. Otherwise, we are getting right into the report. So the agenda for today, we will start out with the economical calendar with the events for next week that we're looking for. We'll talk a little bit about market sentiment, the current and the potential shifts to look for, because this is a big one right now, especially as I mentioned in the last report, we are heading into quarter end flows. So the price action that you are seeing on your charts right now might not necessarily be representative of what the market is actually trying to do. So we'll also take a look at last week's calls, where we once again had 100% hit rate. I don't know how many of these market reports would have had 100% hit rate on. Some people would say that, well, you only do a couple of trades. Well, it's impossible to have 100% hit rate if you do 5-minute scalping. If you do, you're just running a martingale or something similar that will just blow up eventually. So when you do a more combined hybrid trading strategy like I do, where I combine fundamentals with technicals, you do less calls, but you want to do these high quality calls, because if you are putting your own money on the line, you want to do it in high probability trades, right? So we'll talk a little bit about them and how they worked, why they worked. We'll talk about Bitcoin, where bears are still in control. Also highlighting that chart because it has a very nice correlation to what we're actually seeing in the markets right now. We'll also talk about gold, where support keeps on holding. Gold has not changed its fundamental outlook from last report. The seasonality is still in play for gold. So if you're a long-term trader, in gold like I am, building up your long portfolio could be a good time to start doing that. Then we'll do two very brief trade setups. I won't talk too much about them because I just want to leave you with at least two calls for next week. We'll talk about AUDCHF, where the Swiss Central Bank last week kind of surprised the market. So we actually have a new market, a new macro environment where we don't mind going long the Swissy. And we also have a trade potential in EURCAD, where we are basically long in equities because euro is a funding currency, against oil, where we have CAD that has oil exposure. So yeah, that could be interesting. And then we'll do a special ending. Since this is the last report, we'll talk a little about how I trade, which, if you haven't understood it by now, we'll talk a little about that. We'll talk about understanding the themes, understanding the bigger picture, understanding both technicals and fundamentals and how they tie together, and we'll do our goodbyes for now. So, if we jump right into the economical calendar, take a look at it here. So, Monday, not much to do. We don't have any big news. Tuesday, consumer confidence from the United States. This is the type of release, as I have mentioned many times before, that it's by itself, it's not a big one. But if it deviates a lot from the expected figures or the previous figures, then yes, it can be market moving. But just by itself, it's not that big of a deal. Wednesday, we have some talks during the afternoon, so this can of course be market moving. I actually don't know what they're going to They are at the ECB forming Portugal policy panel. Well, yeah, it's three of the biggest hitters in the central bank world. So, this could definitely be market moving depending on what they say. It could also be a non-event, but if you start seeing price action moving during that time, well, then you know what's going on. Thursday, we only have core PCE. That's the price index from the United States month on month. Not a huge one. It's in increments of 0 point in percentage. So I wouldn't place too much emphasis on that unless we see a big exposure from the expected figure. And then Friday, we don't have much going on either. We have a bank holiday in Canada, so don't expect fireworks in the Canadian dollar. But we have ISM, manufacturing PMI, for the US, and that's actually quite a significant reading that gives you a lot of idea of how the economy is doing. So as we are getting that one, and it's a very thin week in terms of data overall, and it's the first day of the new month, definitely expect that to actually push the market around a little bit. Of course, being the new day of the month and the quarter, it can of course be a bit dubious with where price action is actually coming from. But keep an eye out on it. Next up, we are going to talk a little bit about market sentiment, and when doing so, we like to take a look at the VIX. So, if we jump right into the VIX, you can see that we are trading around these levels that we've had previously. We are back below 30, which signals a slightly lower volatility in stocks, in risk. However, this comes from the stock markets actually rallying. So what did I say last week, guys? What did I say? I was expecting a weaker dollar and stronger equities because we are heading into a quarter end and markets are repositioning for the quarter end. What did we get? We obviously, of course, we had not a single red day, and we are trying to fill the gaps. I would not be surprised if this continues all the way up to these levels where you also have the adaptive moving average. So this is what I'm expecting for sentiment for this week. However, this has to do with quarter end flows. This does not have to do with the actual sentiment. The actual sentiment, and why am I saying that? Well, because if we take a look at Bitcoin is a very good risk indicator because it's like a leveraged equity play, okay? And when I say leveraged, it's like if the stock markets move 1%, Bitcoin moves 10. So it's like trading the stock markets with leverage. So if the markets are willing to take on risk, then you see Bitcoin go up. If the markets are very hesitant to take on risk, if they are scared of something, then they don't like to buy Bitcoin. Looking at the equity chart here, you would say that the market seems very willing to take on risk because they are buying stocks. However, if we take a look at the Bitcoin chart, you can see that we don't have a big rally in Bitcoin. We have a small correction. What does that tell us? Well, that tells us that what we are seeing in stocks, what we are seeing in the markets at this point in time, has more to do with quarter end flows. So, you have all these big guys, hedge funds, investment banks, etc., pension funds, all of these big players. They are repositioning their portfolios for the end of the quarter. They are measured in terms of ROI, return on investment, on a quarterly basis. So they want the best figures as possible for the quarter end, but they also want to be in a good position heading into the next quarter where they can start building up their holdings for the next quarter. So that's why you see these kind of fluctuations. We are also heading into the summer months, so you will also see what we call the holiday sell-off, where basically people are the whole finance industry is going on vacation, so they are basically trying to limit their exposure in the markets. Markets will go a little bit quieter, and when doing so, you obviously get flows in the market that has nothing to do with the sentiment. So with stocks rallying like that and Bitcoin not doing much, that tells us that the market sentiment is still pretty poor. There's still worry about inflation, there's still worry about recession. But that's not what we are trading right now. We are trading what the markets are doing. So when trading, for example, stocks, I would still expect them to move a little bit higher heading into this week. If we take a look at the US dollar, same thing goes there. We are not seeing that deleveraging we were expecting. It's just hovering around these levels. It's just the stock market. So be careful heading into this week. Next up, last week's calls. First of all, we had Euro Yen. No, sorry. Let me start with dollar CAD because that's easier to explain. I mentioned dollar CAD. If you took the trade like I highlighted it on the chart, you have currently 107 pips in profit, which should be just above 1-to-1 risk reward. Yeah, so if you want to keep holding it, you do that. Me personally, I would not hold this trade. I'm already out of it because I didn't want to hold any oil exposure over the weekend. Now, I'll talk a little bit more about oil later on, but as it seems, we could see some sell-off in oil heading into Sunday evening. So we are at support, but we got some news coming out during the weekend that could potentially push the price of oil lower, and when doing so, we could see the dollar move higher and the CAD go lower, meaning that this trade could move higher again. So if you're in this trade, I would cut it, but nonetheless, it's a green trade. You made pips if you're in it, so happy days. If we take a look at Euro Yen, which was the other trade that we took, this one, I mentioned we wanted to see how it behaved on the market open, and we just rallied very, very hard. So depending on how you trade technicals, you could have traded this double top, obviously. Now that's not what I did. I went on a lower time frame. I think it was the 1 hour. Yeah, it was. And I basically got an ABC pattern up here where we got the bearish breakdown. I was able to take the trade. I based my stop loss 36 pips, and down here you have the ATR, and at that time it was just at 35.6 pips. So basically the average trading range told me that, hey, this is what the price can easily move in this currency pair, and that's where I placed my stop loss, and I targeted just below here. And what I do, this might come as a new one for you. This right here is a trend-based Fibonacci expansion. And what I do is that I go from the highest high to the start of the most recent move, and then I go back to the highest high. Okay? So I go from the high point of the current trend, and I go to where that move started, and then I go back. And I get this projection, and at 127 area is where I'm targeting. Now, in this case, we didn't get it. We moved just right down below it, and we actually got another ABC pattern down here that was bullish. And when this candle peaked below that and closed above that ABC pattern, I decided to close the trade because that told me that we were not moving lower. The odds for this pair was that it was moving higher. I don't have time to explain ABC patterns to you, but if you go online and search on YouTube or whatever, obviously you will be able to find more information about it. So that was a great trade. I had 6.6 risk reward, so amazing trade. That's how I trade technicals, basically. So that was the two trades from last week. Let's look at this week, and let's start with Bitcoin against the US dollar. So looking at BTC on the daily chart, as I mentioned, not going to put too much time on this. We have a very, very small pullback. We are closing in on the adaptive moving average, but this is once again Bitcoin just a risk proxy. I don't have a trade on it. My take on it would be that, price continues slowly creeping upwards together with stocks, and then as reality starts kicking in again after the quarter end flows, we see Bitcoin starting to move lower again. That's my take on it. Can it change? Of course, but do I have a trade set up on it? No, but that's what I would look for. Gold. So the gold, the play has still been buying from support. I keep having this highlighted area right here. We have bullish divergence that push the price of the pair higher. So yeah, and we still have the seasonality that I mentioned in last week's report. So if you want to trade gold, you should really go and look at the last weekly report, because that was a really in-depth analysis of gold. I still want to buy gold. I still want to keep on building up my longs in gold to the upside. I think there's still potential for it to push higher. We have the inflation problems, we have the seasonality, and we have some levels to work with on the daily chart. So if we break lower, I'm not looking to short it. I'm just looking for new lines in the sand of where it starts stabilizing, where I can continue going long, basically. Trade setup for this week: AUDCHF. So why do I want to trade AUDCHF? Well, we've had this fair value consolidation. You remember last week I talked about fair value consolidation. AUD has exposure to commodities, but it also has exposure to equities. So AUD is generally a risk asset, so risk currency. So it likes when stock markets are going well, and it doesn't like when stock markets are going bad. However, if we take a look at this chart, you can see that the AUD has actually gone down when the stock market has gone up. Once again, what I talked about, what you are seeing right now in stocks is not representative of the actual sentiment in the market. Markets are still very, very hesitant to take on risk. So we have broken down to the downside. Now, the big thing here is that last week the Swiss central bank shocked the markets. They are starting to move away from their stagnant rates, and that means for us and any trader out there that has been looking to buy Swiss franc but hasn't really dared doing so with the track record of the Swiss central bank historically. If you don't know what I mean, Google Swiss PEG 2015. Now the Swiss central bank is actually starting to move a little bit in a way that you can feel more secure actually buying Swiss francs. So with that said, this has broken out, and I think there's still room for it to move to the downside. So what I'm going to do is that in next week I will either, whatever comes first, I will look on the daily chart and I will look for a pullback into the moving averages. You can see they are starting to turn over. I will look for a pullback into them that I can sell off, or I'm going to go on a lower time frame and I'm either going to look for bearish divergence or I'm going to look for an ABC pattern that breaks. So you see you have a lot of like this bearish divergence and this bearish divergence here would have worked out. These two not so much, but you know it's not really it's more of a consolidating market than anything else. So either a clear cut divergence or a ABC pattern that I can trade to the downside. That's what I'm looking for in that pair next week. Next up, EURCAD. So EURCAD, I'm saying longing equities against oil. What I mean by that is that euro is a funding currency, so it's basically somewhat correlated to market sentiment, market risk. So if stock markets keep moving higher, we could see the euro push higher. On the other side, you got the CAD that is obviously very, very tied into the oil price. So, and as I said, during this week, there has been an agreement between Iran and the Eurozone to start picking up the nuclear deal talks, I should say. So what does that mean? So that means that we could see late Sunday evening European time, when the market starts opening over in Asia, we could see stocks rally even more, and we could see oil drop on those news. So with that said, if we see stocks rallying, you could see a funding currency like euro rallying, and with oil falling, you could see a oil price tied currency like the CAD falling. So if the euro goes up and the Canadian dollar goes down, well, obviously EURCAD should explode to the upside. Does that happen? We'll have to wait and see how big of an impact it actually has on the markets. However, we are in this very basin price action down here, so it's obviously very poised to make a move in either direction. Now, obviously, we have a lot of moving average resistance that we need to take out, and the general trend is to the downside. But what I will do is, because when you watch this, we have already had the Sunday opening. So what I would do is that I will look for a daily candle closed above this blue line. If you can get a daily close of this daily candle above the blue line, then I would look for a trade, and I will base that trade doing it with, for example, somewhere around here, and I will base it against the lowest swing low, basically the closest swing low, and I will target the upper regions for at least somewhere around up in here. Okay, so this is going to be a little bit longer report, but it's the last one that I'm doing, so let's jump, let's move on basically. So what I wanted to talk about to end off with is more of an explanation about how I trade. So something that you've probably seen by now is that I don't just stick to one thing. I don't just say that I'm going to use fundamental analysis. I don't just say that I'm going to use technical analysis. I don't just do ABC patterns. I don't just do trend lines. I don't just do moving averages. I don't just do central bank divergence, etc., etc. You combine it. Why? Because what you want to do is that you want the highest probability trade possible to risk your money in, right? You have all these trading educators and gurus, etc., around the world. They want to make trading look easy. Trading is easy, but it's not simple. Okay? What I mean by that is that you don't need to be super good at math. You don't need to be like, for example, when you work with stocks, you have to be better at understanding, doing corporate analysis of balance sheets, etc., etc. You don't have to have that in the FX and the crypto space. But it's not that simple that you can just trade off a trend line, or that you can just trade off a moving average or whatever. And then, once again, I've been trading for 12 years, so I've heard all of the rebuttals to this. And you will tell me that I know a guy, or I have a friend, or my cousin's father's brother, etc. Somebody trades only using moving averages, and it works so well. I bet it does. Because you can make money just trading off moving averages. But, here's the thing, is it the most effective trading strategy for you? I don't think so. George Soros, Google his name, billionaire, sketchy dude, but yeah, big in the FX space also back in the days. Broke the pound, etc. He once said, as soon as you can have just a slightly positive hit rate, so as soon as you can have 51% profitable hit rate against a 49% negative, you're making money. And that's true. You're making money on a 51% hit rate because you're making more profits than you're making losses. How much money do you make though? And that's the thing. That's what everybody forgets in this industry. On a 51% hit rate, on a moving average only trading strategy, where you probably will have something like 51% hit rate or something if you make money with it. How much money do you make? Do you make money? Yeah, maybe. But you're not a hedge fund. You don't manage billions. So making 0.05% a year doesn't make any difference for your personal situation. Making 1% profitable hit rate won't make any difference for your personal situation. So yes, There are many simple trading strategies out there. And there are many ways to trade where you just make a little bit of profit. But you don't have that opportunity. You are not a hedge fund. You don't have the capital where making just increments on that capital will make you wealthy. You're a day trader. You're a private retail trader. And same thing actually goes when you've had the background like I have. When you work on a professional trade desk, they measure you all the time. You can't have red weeks, you can't have red months, you can't have red quarters. Maybe one. If you work at a very forgiving place, maybe two. More than that, you're out. Because they have more talented people, they have smarter people that can take your place and trade better than you. So you don't want to sit there and make these small profits. No, you want to make significant returns while keeping your risk in check. And if you're going to do that, you can't just draw lines on a chart. You have to understand the bigger picture, and that's what I'm trying to get at here. When you have seen all these trades that I've called over the weeks and months with IMG now, you have seen me saying all the time that the technicals and the macros line up. I want as many things as possible lined up. I want as many people as possible in my ring corner when I go into the fight against the market. Okay? That's why when you have a trade like EURCAD I just spoke about, you have to understand that euro is a funding currency. CAD is a commodity currency. The CAD has exposure against the oil price. So what the oil price will do will affect the price of the Canadian dollar. So if you're going to trade a Canadian dollar, you have to look at the oil chart. Then when you have your fundamentals lined up, you look at technicals. And same thing there. You don't just trade one thing. You have to look for whatever structure is suitable for your trading strategy, but that can't just be a trend line or something like that. Me personally, I like divergence very much because it's a good momentum indicator. As I've told you before, I work a lot in producing algos, and when doing algos, it's just ones and zeros, and when doing that, you have to quantify how the bot is supposed to trade. So what I've come to learn over the years is that something like divergence is a good momentum indicator. That's why I like momentum. It works well in algos and it works well in manual trading. Another very good in the technical analysis is ABC patterns. Once again, very good for entries and timing the market. Works very well in bots, works very well in manual trading. That's my two go-to ways of entering a trade. Then obviously I will look at the market structure. Are we in a consolidation? Are we in a fair value currency pair that has exposure to commodities? So you start to see what I'm talking about. You have to have this bigger picture. What's the risk sentiment? What are the stock markets doing? When you start seeing this bigger picture, and I've seen this so many times with traders that I talk to, traders that I coached, traders that are just in my Discord talking to me, that I don't even charge anything, we just bounce ideas back and forth. When we talk, you start seeing when people start getting this bigger picture, when they start seeing the bigger picture, how everything ties together, man, I tell you, the trades and the profitability that these people start reaching, it's insane. Because that's how you trade professionally. When I say professionally, I don't mean professionally from home. I mean that's how you trade professionally in an actual company like I have done. You can't have the jobs that I have had coming there just talking about trend lines. It doesn't work, okay? So you have to understand the bigger picture. Now that bigger picture can be built up from your own area of expertise. You don't have to use my technicals. Now macro and fundamentals, they are a bit the same no matter what, but obviously you can look at different stuff, but you can still build your own strategy, but you build it around a larger picture. That's when you start getting really profitable. Trust me, If I legally could say that I guarantee it, I would say I guarantee it. Now legally I can't say that I can guarantee it, because if you lose money, that's not on me. That's just how the market works. But it's the best way forward. So if you want to learn more about that, if you want to learn more about how I trade, feel free to shoot me a DM and we can talk about it on wherever, LinkedIn, whatever. If you want to get into my Discord, you can also contact me through whatever social and I'll get you in there. It's all for free, and we are just a bunch of traders in there bouncing ideas back and forth. I show all my trades that I do, and people just do whatever they want with information. It's all for free. Adding to that, if you want to if you're not a client of IMG yet, then I suggest you join them. They are a reliable broker. However, our collaboration has come to an end. I will not be doing any more market reports in the collaboration with IMG. So I hope you have enjoyed these reports. If you have, feel free to leave a like. Feel free to shoot me a DM and tell me that you enjoyed them. I would be very glad to hear that. And until we see each other again, I wish you a profitable and safe ending to the year. Take care, guys. Bye bye.